In the world of Forex trading, it's easy to get caught up in the technical side of things: charts, indicators, candlestick patterns. But if you're ignoring fundamental analysis, you're missing half the picture. Today, we're diving into the top 5 fundamental factors that every Forex trader should understand. These are the forces behind the charts, the real-world events and data that move currencies in the first place. First up, interest rates. Central banks control monetary policy, and one of their most powerful tools is the interest rate. When a central bank raises interest rates, it attracts foreign capital, increasing demand for that country's currency. Lower interest rates, on the other hand, tend to drive that demand down. As a trader, it's crucial to stay updated on interest rate decisions and forward guidance from institutions like the Federal Reserve or the European Central Bank. These decisions often spark sharp movements in currency pairs, and anticipating them can give you a significant edge. Second, inflation. Inflation reduces the purchasing power of a currency. If inflation is high and unchecked, it can lead to a loss of confidence in a currency. However, moderate inflation is often seen as a sign of healthy economic growth. Traders pay close attention to inflation data like the Consumer Price Index, CPI, and Producer Price Index, PPI. These reports can affect central bank decisions and, in turn, influence currency strength. Watching how inflation data aligns with market expectations can give you insight into potential price moves. Next, we have employment data. One of the most watched reports in Forex is the U.S. Non-Farm Payrolls Report. Strong employment numbers usually signal a healthy economy, which can lead to stronger currency value. On the flip side, weak job numbers might indicate economic trouble ahead. But it's not just about the headline number. Details like wage growth and labor force participation can also sway the markets. Traders use this data to form a macro view of a country's economic health, which directly impacts currency strength. Coming in at number 4, GDP, or Gross Domestic Product. This is the broadest measure of economic activity. When a country's GDP is growing, it usually indicates economic strength and can push its currency higher. Conversely, a declining GDP might signal recession, lowering investor confidence and weakening the currency. It's not just about the number itself. Expectations play a massive role. If the GDP growth comes in better than forecast, the market tends to react positively, even if the absolute growth isn't massive. Finally, political stability and geopolitical events. Currencies thrive on certainty. When a country is politically stable, its currency tends to be more attractive to investors. On the other hand, political turmoil, elections, or even international tensions can create uncertainty, making traders more risk-averse. This often leads to capital flight and weaker currency values. Staying on top of the news and understanding how political developments could impact a country's economic outlook is a must for any serious Forex trader. So, how does this all come together in your trading strategy? Well, one powerful way to combine fundamental insights with real-time market data is by using a trend confirmation tool like the Apex Trend Indicator by FX Limit. Let's say inflation is surging in a country and you expect its currency to weaken. Apex Trend Indicator helps you confirm that bias by showing you whether the market is already trending in that direction across different time frames. It doesn't repaint signals, and its dashboard helps you track multiple pairs at once, so you're not just guessing, you're trading with clarity. And the best part, you get dynamic entry and exit points, success rate stats, and signal alerts straight to your phone or desktop. Whether you're trading based on central bank moves or geopolitical shifts, having this kind of visual and data-driven backup can help you make smarter, faster decisions. So the next time you're about to jump into a trade, take a step back and ask yourself, what's the story behind this move? Are the fundamentals pointing the same way as the charts? When both align, that's when you find the highest probability setups. Thanks for tuning in to FX Limit. Don't forget to like, subscribe, and hit the bell for more Forex insights. Happy trading, and we'll see you in the next video.